Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of business filings. Today we're diving into Park National Corporation's latest quarterly report. Let me tell you, some of these reports are drier than a popcorn fart, but don't worry, we'll extract the juicy bits for you. This report tells us how Park National, a big bank holding company primarily in Ohio, did in the first 3 months of 2025. The big headline, they made more money than they did a year ago. We're talking about tens of millions of dollars, but let's see what's really going on beneath the surface. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more in-depth discussions. First up, the balance sheet, which is like a financial snapshot of the company. At the end of March, they had about 9.9 billion in total assets. We can compare this to the end of the previous year. At the end of 2024, that number was 9.8 billion. So their assets grew a bit. Now, let's scroll down and look at the deposits. They had 8.2 billion in deposits at the end of March. This is super important because banks use deposits to fund their lending, and we can compare this to the end of last year as well. At the end of last year, total deposits were about 8.1 billion, so that's also a small increase. This indicates their customer base is reasonably stable and that they are retaining their customers. Let's scroll down to the income statement to see how they are actually making money and look at their bottom line. For the first 3 months of 2025, Park National reported a net income of 42.2 million. That's up from the same period last year. So it's worth it to dig in and see where that growth is coming from and at whose expense. For the first 3 months of 2024, they made 35.2 million, so they increased their net income by about 7 million in a year. This translated to basic earnings per share of $2.61, compared to basic earnings per share of $2.18 last year. Good growth. It's worth noting that these earnings were spread across 16.1 million shares, so there isn't significant dilution in the shareholder base. Now, dividends per common share were $1.07, slightly up from last year, but nothing too notable here. A good sign for shareholders. Okay, the statement of comprehensive income lets us see the true financial story, capturing items like unrealized gains or losses on investments. We're scrolling fast since it can be a little dry. Here's the start, net income of 42.2 million, as we said before, with other comprehensive income being 11.5 million. Adding those up, we get comprehensive income of 53.7 million. All good so far. The statements of changes in shareholders' equity lets us see what's the story when it comes to investors buying, selling, and the actions of the company itself. Here we see the net income again, plus a couple other interesting items below, like dividends on common shares, basically money going out the door. Share-based compensation is also an item worth tracking because although it isn't cash, it indicates a long-term commitment in growth from the company and how the company itself views its growth. It could be worth digging a bit deeper to see who gets the compensation, but we won't do that in this analysis. The statement of cash flow shows how the company actually generated and spent cash. This can be different from the reported income because of various accounting practices. A reminder of the net income number to start, plus all of these adjustments lets us see the net cash provided by operating activities, which you will typically see highly correlate with the profitability of the company. The net loans is a super important value, since that tells us how the lending activities are actually doing and if they are growing or declining. Now let's move on to the notes. These are super important because they give us the context behind the numbers. Let's scroll to one of the most important things to look at in the notes, new accounting rules. A lot of reports are just following new rules. However, there is one that might be worth looking at. The income statement reporting comprehensive income expense. Disaggregation disclosures may impact future reports and change some of the ways that the financial statements are set up. Nothing too impactful for now. Next up, investment securities. They are also measured at fair value, so it's important to see how this is actually calculated and some of the assumptions that go into it. Here's a level breakdown showing the amortized cost, gross unrealized holding gains, gross unrealized holding gains, gross unrealized holding losses, and fair value of their different investment securities. What's more interesting though is the unrealized loss position for less than 12 months versus unrealized loss position for 12 months or longer. The longer the unrealized losses exist, the more concerning it can be. There are no immediate signs of danger in the company right now, however. Now let's quickly check the affordable housing tax credit investments because, well, we're thorough. Not that many changes to the structure since last year. Time to check what's going on with the loans. These PCG loans have had deteriorated credit quality when the company bought them. They're basically buying someone else's headache. That said, they also have an allowance for credit losers. So this means they expect to take losers from these loans. It all boils down to the quality of the numbers and what they are betting on as the upside case. Let's skip adoption for now and focus on credit quality. Here they tell us if the borrower pays them in cash, in loans, and some amounts that are loans past due. We want to look into which ones are the 90-day ones. All right, enough of that. What does the rest of the report say? What's next? Here's where they tell us about their non-GAAP measures, basically adjusted financials that are not audited. This is an interesting table to see what the management cherry picks as the values that matter, and it's important to understand what the changes are relative to that as well. And for our final scroll, let's look at loan transfers to Oreo. What are they doing with Oreos? They seem to be doing an okay job. They are still lending a reasonable number of home equity and mortgage loans. However, not enough commercial loans compared to the numbers that they want. Alright, so Park National made more money. It had modest growth in assets and deposits. Some of the credit metrics are improving, and the management seems to be steering the ship reasonably well. The trend of economic uncertainty is of course worth keeping an eye on for the next report. What is interesting here is that they are selling debt securities, while the broader market expects interest rates to decline. They are betting against the market. Maybe they know something we don't. To dive deeper into specific segments and see how each is performing, more info would have to be known about the actual company loans, but the big picture looks pretty good. One thing to note, and as also shown in the risk analysis, a key weakness remains in the stock price and its ability to retain value for its shareholders. Perhaps a renewed focus on shareholder interest would be in order. Alright, that's our breakdown of Park National's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.